Now, as I'm sure our listeners and viewers are aware, Social Security is a cornerstone of income for millions of retirees, but often people are shocked to find out the money they've paid taxes on during the working years, well, guess what? It can get taxed again in retirement. Nolan, as you mentioned previously, up to 85% of a retiree's Social Security income can be taxable. Is there a way, or what are three ways actually to help reduce or eliminate this tax?
There definitely are three ways to reduce Social Security taxes. If you look at it, what happens is you have what is called provisional income. So whether you're a single or a married couple, part of your income becomes 50% taxable for Social Security benefits, and it can go as high as 85%, dependent upon what is considered your countable income. And if we think about countable income, that would be things like work income, income that you earn from, taxable dividends and interest. It could be withdrawals on money that you take from your 401k or your IRA, and also half of what your Social Security income is. They put that all together to figure out this formula on how much they can tax you on money that, well, quite frankly, you already paid taxes into. And it is a shock, I think, for many retirees to find out how much they can ultimately pay in the form of Social Security taxes. So this is one of those areas that proactive planning can really help you. And, in the team approach, when we're looking at things like reducing taxes, with the team approach, looking at taxes, estate planning, asset protection, and money management. Again, with our relationship with retirement tax partners, we can run a Social Security optimization report, and we can look at different ways and give you specific ideas on when might be your best approach on drawing Social Security. But the three ways to reduce Social Security taxes is number one, consider delaying benefits. And in the earlier years, you could do Roth conversions. So one of the advantage of a Roth conversion is if you follow the rules of, how a Roth is set up, meaning that you've had it for more than 5 years and you're 59 and a half, you begin to take withdrawals from that account. The Roth is not going to be considered in the calculation to determine whether your Social Security is taxable. So a common approach will be people will begin to draw Social Security benefits right when they retire. But by doing that and then taking money out of their 401k or IRA to supplement their income, that combined income is what oftentimes will be one of the ways that creates this Social Security tax problem. If instead in the early years you did Roth conversions, by delaying Social Security, one, you're going to get a higher benefit by delaying Social Security. And two, because of that higher benefit later in life, you then also, if you have these Roth accounts, have the ability to have more control on what's considered taxable income in the future. So again, number one, delay benefits and do Roth conversions. Number two is you want to minimize the taxable income that's reported on your tax return. So as I pointed out before, when they're looking at how much they can tax you on your Social Security, they're adding in things like the amount of dividends and interest and, capital gains that you have. A way to consider reducing those amounts, because I love income sources, right? Everybody loves capital gains, but it comes down to what's called asset location. So you might want to have more of your dividends and income generated in your tax deferred retirement accounts, like your 401k, your IRA, or your Roth IRA, because that doesn't show up, again, depending upon how you take withdrawals out of the account. And, have more of, say, your growth oriented investments that you can control when those investments are sold, or also consider things like municipal bonds would be an example to help minimize some of the countable taxable income that you have. Number three is to use qualified charitable distributions. There's a lot of people that we work with that love helping support either their church, a charity, or a cause that's important to them. And what oftentimes we see is people over the age 70 and a half will take money out of their retirement account, it goes in their bank account, meaning that it's fully taxable and included in that formula to determine the taxation that you pay on your Social Security benefit. They then in turn will write a check to their church or charity, making that donation. And I think that's fantastic that they're supporting an organization or cause that's important to them. But understanding that qualified charitable distributions give you the ability, if you follow the rules, where you can take that distribution and you can donate it directly to the charity. The advantage of doing that is now the charity is going to be able to get it. They're not going to have to pay taxes on it. Number two, it's going to help solve some of your what's called required minimum distributions if you're subject to required minimum distributions. And number three, it's going to keep that income off of your federal tax return, potentially reducing your Social Security taxes. So, again, three ways to reduce your Social Security taxes. And if you want to find out more, again, we can run the Social Security Optimization Report, and we can also pull in our relationship with retirement tax partners to give you a specific what if analysis that could help you determine how to keep more of your hard earned money.
Figure out how it all works together, because if you neglect one or the other, it could certainly work against you. And I don't think anybody wants that in retirement. Set up a time to speak with the team at America's Retirement Headquarters. Start developing that plan to make sure you get to keep as much of your hard earned money as possible. 419-794-3030 is the phone number. That's 419-794-3030. Or you can also get that Social Security Optimization Report by reaching out at arhq.com.